Welcome to this presentation on put call parity of European options. Here we'll cover various aspects like the fundamental parity equation, the portfolio values under different scenarios, arbitrage opportunities, and implications of parity violations. So let's get started. Put call parity is a fundamental relationship that links the prices of European call and put prices with the same strike price and the expiration date. The put call parity equation is given here, where C is the call premium, X is the present value of the strike which is invested in the form of a bond, a risk-free bond, P is the put premium, and S is the current price of the underlying asset. Now, parity violation creates an arbitrage opportunity with no risk profit on settlement of the options. Traders will execute trade to bring prices back into parity. The two portfolios created as per parity equation maintain same values on the option expiry regardless of the stock price movement. Presented by Aninda Datta. Now, what is a put call parity equation? The put call parity equation is given in the attached diagram. It says the call option premium with strike K plus the present value of a bond having face value of K is equal to put option premium with strike K plus the current stock price. The calculation of call values and put values are given based on the input variables in the box 1. Now you can see that the call and put values have been calculated, and both sides of the portfolio values in the put call parity equation are having the same values of $21.66. So the call price is at 2.44 and put price is at $1.66. But here both call and put values have been calculated assuming the same implied volatility of 26% as mentioned in the box 1. However, in real life, call and put options of the same strike price gets quoted at slightly different implied volatility, so small arbitrage opportunity always exists. If an investment is made exactly as per this parity equation, then the values of both the portfolios remain equal regardless of the share price. Now testing the portfolio values when the stock price changes. Now we'll change the share price and examine how the portfolio values are affected. Let each side of parity equation be one asset. Portfolio A contains one call with strike price of $20 and a bond having face value of $20. Portfolio B contains one stock of $20 and a put with strike price of 20 and put expiring at time T. The bond being risk-free will always have a value of $20 at time T. Suppose at time T the stock price reached $25. Now the graphs show values of two portfolios when the stock price reaches $25 at time T. Now you can see in the first graph, which is the call plus the bond value, the bond being risk-free reaches a value of $20. and the call being exercised at 20 and the stock price is 25, so the call has a value of 5, so both the components add up to $25. Now in the second graph, which is the share plus the put value, is shown here. Now in both the graphs, that gray shaded regions are the total value, indicate total values of the portfolio. So in the second graph, containing share plus the put value, the put value is 0 as the share prices increases, but since the share price has increased to $25, so share price comprises the entire portfolio value, so it's also $25. So the total value of both the portfolios is $25 at time t. Now let's test the second case where share price falls. The graphs show the values of portfolio A and portfolio B if the stock price reaches $15. In the first case, where the portfolio contains call plus a bond, as the bond is risk-free, it reaches $20 worth, and the call is worthless because the share price has fallen below the strike price, so the total portfolio value is $20. In the second case, the portfolio contains share plus a put at $20 strike on that. Now since the share has reduced to $15, the put value has become $5, the difference between strike price and the share price, and both add up to $20. As could be seen from the graphs, the value of both the portfolios is same when the stock price falls to 15. As could be seen, the values of both the portfolios are same regardless of the stock price at time t. So this implies that values of both the portfolios should be same at time t0. If the portfolio values are not same at time t0, then that would give arbitrage opportunity, risk-free arbitrage opportunity. Now, distortion to call put parity. Now, what if call and put market prices for options having same strike price and expiry date are different? Now let's see how distortion in call put parity leads to risk-free profit earning opportunity in the market. Now the box shows the call put parity equation which was used in the previous slides, wherein both value of portfolio A and portfolio B was same at $21.66. Suppose the market price of put increases to $6.66. Thus the second portfolio is more expensive by $5. As obviously short the more expensive portfolio, so we short portfolio B and long portfolio A. Thus we gain $5 in the process. Now let's see what happens to two portfolios in case the share price falls to 5 in one case and rises to 30 in the second case. Now let's examine the impact of share price movement on the two portfolios. Situation where share price falls to $5. Now the table shows the initial put call parity and compared with the second situation where the put price increases and we have shorted portfolio B and long portfolio A. Now what happens at time t when the price of share falls to $5 at time t? The bond value is worth $20 as bond is a risk-free asset. Since the price of share has fallen, so the call is worth 0. So no cash transaction is necessary on settlement of the call. So the total value of the portfolio at time t is $20. Now we shorted the stock at $20. Now at settlement we have to repurchase the stock and settle the transaction. Since the stock price is $5 now, so the stock is repurchased at $5 and settled. Now since the investor had shorted the put with a strike price of 20, now to honor that commitment, he needs a cash outgo of $15. Thus his total cash outflow is $20 on the entire position settlement. The bond worth $20 is used to cover cash outgo of $20 from portfolio B. Thus the net cash position on the settlement of the entire position is 0. The investor keeps the $5 earned at the inception of the transaction. In the previous slide, we considered a situation of share price fall. Now let's consider a situation of share price increase. Situation where share price increases to $30. As last time, here also we long portfolio A and short portfolio B. Just because the value of portfolio B is higher after increase in price of the put. Now let's see how the portfolio pans out at the time of settlement at time t. No cash flow in case of the bond as the bond price rises to $20. As the share price rises to $30 and the call has a strike price of 20, so there's a gain of $10 on that call. Thus total bond plus cash from call purchase comes out to be $30 in hands. Now let's see what happens to portfolio B. Since we shorted the portfolio, since we shorted the stock at $20, now the stock needs to be repurchased for $30 and the short position is settled. The $20 strike put is worthless, so no cash transaction on its settlement. Thus total $30 of cash outflow is involved in the position settlement of portfolio B. The $30 gain from portfolio A is used to cover outgo of $30 from portfolio B. The net cash position from the settlement is 0. The investor keeps the $5 earned at inception of the transaction. Now thus we can see the investor earns profit in the scenarios of share price movement in both directions, demonstrating risk-free profit for these portfolios. Now let's see how put-call parity works in real world and some limitations of put-call parity theory in the real world. In the given example, both call and put options have same implied volatility of 26%. However, in real world, the parity is not perfect, so call and put quote at slightly different implied volatilities. So small arbitrage opportunity always exists in real market, but the opportunity keeps shifting as values of stock, put option and call option are totally dynamic. The limitations of put call parity. Parity does not hold good for non-European options like American options or Bermuda's options. Dividend assumptions can also affect the put-call parity relationship, as the amount of dividend factored in the call price can distort the put-call parity. Real-world costs like commission can also impact parity. Here commission means trade commission, the brokerage, all those stuff. Limits on trading volume may also prevent full parity, as some stocks may come under, stocks or options or any derivatives may come under some scrutiny from the regulator, and some restrictions may be put on trading, so that may impact the put call parity relationship. Now let's examine some uses of put call parity in real trading world. It is called parity because values of both the portfolios are equal always on option expiry. So one cannot make profit by being long on one side and the short on the other. Helps determine the fair value of options. The parity equation could in turn be used to find out the lower and upper range values of the options. Arbitrage opportunities. Parity violations enable low risk profit opportunities. Moreover, nowadays the computer-based algorithm programs can much easily detect these parity violation opportunities, trading opportunities. Spread trading allows traders to take advantage of price discrepancies and devise spread-based option trading strategies. Risk management provides insights for managing option portfolio risks. Market efficiency helps ensure option markets are efficient. So this concludes this presentation. Thanks for watching.